Good evening, everyone. Thank you for joining us today for this session on latest updates on GST. This is going to be a 45 to 50-minute session where we're going to deliberate on the recent changes that have happened in GST, predominantly through amendment to the through the Finance Act and changes in the rules. We will be going through notifications 27, 28, 38, and some bit of an advisory which has been issued by the GST portal a couple of days back. So the way we have structured the PPT is the most important topic which we thought would be relevant for all of us will appear chronologically. So that means the first few topics, according to me, are very interesting and very impactful for people here. I see a lot of people here who may be impacted due to such changes. So we'll be dwelling more on the interesting topics first. So first 20-25 minutes, according to me, is very interesting. Later we have smaller procedural changes which are there, which might impact few of us here. So that's going to be the structure. So there is no index here. So I'll take you through point by point. We will see how to discuss each of the points. The first of the points is the most important change that I see that is happening through an amendment to the Finance Act, through the Finance Act in the IGST Act. There is a change in IGST Act while defining what is a zero rated supply. This also is very important for us to understand what was the impact prior to introduction of this particular provision. You will have to know that this particular amendment which we're going to discuss now is applicable from 1st of October 2023. That means we have a little over 20 days time to implement this particular provision. This provision with its implementation from 1st October also gives us some glimpses of how the government is viewing this particular transaction, which is zero rated, all this while, right from 1st July 2017 till 30th of September 2023. OK, let's jump into what the change is. So we know that any supply which is made to an SEZ unit or a developer was treated as a zero rate supply. We also know what does a zero rated supply mean. Zero rated supply means it is a taxable supply. However, it has been given a beneficial treatment of not paying tax on it, or even if you pay tax on it, you will be given the refund back of the taxes that you pay on the supplies made to a SEZ unit or a developer. If you look at the law presently, why am I saying presently? Because this particular provision, even though has been given a date, is only applicable from 1st October. So presently, the way it reads is supplies to a SEZ unit or a developer is treated as zero rated. Now, with the amendment coming in, they say that supplies to SEZ unit or developer for authorized operations is what is termed as zero rated. So the difference now between what is today and what is tomorrow is the authorized operations. So now we know with this coming in, what will happen. So if something is treated not to be for authorized operations of the SEZ unit or developer, the same would have to be considered as a regular supply. What would a regular supply mean? Like any other B2B supply. However, keep in mind that even though the supply is treated as a regular supply, even if you being a supplier, you're in say Karnataka, and the SEZ unit or developer also is in Karnataka, because it is regular supply does not mean I can charge CGST, SGST. We know that IGST Act has told us that whenever any supply is made to SEZ, it's always to be termed as an interstate supply. That means even if something is not for authorized operations of the SEZ unit or developer, by virtue of this amendment, those being called as a regular supply, it still continues to be an IGST transaction and not a CGST, SGST transaction. OK. Now, this is very interesting for me because all this while when the departmental audits were going on, Section 65 audits were rampantly happening. Even now it is happening from both center and the state levels. The primary or the first question whenever a SEZ transaction is looked at is, do you have an endorsement from the SEZ officer, or how do you prove the supply that you're making to the SEZ unit or developer is for authorized operations? We have been all this while trying to explain to the officers that for authorized operations is required only if I, being a supplier to the SEZ, is going for a refund. Why so? Because Rule 89(1) in its proviso says that if you, being a supplier to the SEZ unit, is exporting, I would say export because SEZ unit is termed to a place outside India, or a supplying to a SEZ unit or developer, you are given the benefit of refund of your accumulated input tax credit. If you want to claim refund of the accumulated input tax credit, the requirement under Rule 89(1) proviso was that it should be for authorized operations. So the document which the department was relying on to say whether it is for authorized operations or not was through an endorsement of the invoice that you had raised on a SEZ unit or developer. Now, this particular explanation which we were taking or giving to the officers during the course of audit is probably seeing the light of the day. Why so? Because now with this amendment, which is only a prospective amendment effective from 1st October, it is definitely possible to take an argument that from 1st July 2017 till 30th September 2023, even if a particular transaction or a supply which you were making to an SEZ unit was for whatever reasons was not for their authorized operations, it is still possible to be argued that the same has to be zero rate supply. Why? Because any supply to an SEZ unit or developer by virtue of section 16 is a zero rated supply even today. Okay, so I hope I'm clear here. So this could definitely be an argument which we can take. Now, by virtue of this amendment, which will take effect from 1st October, you will have to ensure few things now. How do you prove what is for authorized operation is not defined in GST law? That means there is no answer in GST law. We have to go into SEZ Act and the rules thereon to understand if something is required for authorized operations or not. So we know we can have situations where I could either supply goods to an SEZ or I can supply services to an SEZ. By virtue of our reading of the GST law as well as the SEZ provisions, what we are saying is in case of any supply to SEZ, you will have to ensure two things to call yourself to be eligible for zero rated. One, you have to ensure if you are supplying goods, the goods have been admitted in full into the SEZ to which the SEZ unit or developer belongs. Second, you also have an endorsement given by the specified officer of the SEZ to call yourself to be eligible for the zero rated benefit under section 16. This is for supply of goods. Now coming to supply of services, unlike goods, you cannot prove that services have been admitted in full in SEZ unit or developer. Thereby, what we have to rely on is there is a default uniform list of services issued by the USC approval committee of the SEZ, which has listed 69 list of services, which by default is believed to be used for authorized operations of the SEZ. That means if the services that you're performing to the SEZ unit or developer falls in one of the 69 list of services, that means you don't have to prove anything further to say it is for authorized operations of the SEZ unit or not. So you can by default be rest assured that the service which you're performing, since it is in the default list, is for authorized operations of the SEZ. So this is one primary condition which you have to tick. Second condition, like for goods, you also may have to get a endorsement on the invoice that you're issuing on the SEZ unit or developer from the specified officer of the zone. Like goods, even for services, endorsement, according to our reading of the law, is a requirement because that is the evidence to say that in the particular SEZ, for the particular customer or the unit or the developer, these goods or services have been accepted by the officers to be for their authorized operations. So these tests may have to be conducted to ensure that you get the benefit of zero rated. How do you get this? Now, it's very important because at the time of you getting a purchase order or work order from the SEZ customer, you will not be able to understand whether you will be able to fulfill these conditions or not, especially the endorsed invoices, because you can at least be rest assured you will deliver the goods to the SEZ unit. You can at least be rest assured that your services are either falling under the default list or not falling under the default list. But you are not very clear whether tomorrow your SEZ customer will be able to get an endorsement on your invoice from the specified officer or not. Thereby, your contractual terms may have to be undergoing some change to bring in a clause to demonstrate that in case tomorrow your customer being a SEZ unit or developer is for whatever reason is not able to get the endorsement on the invoice that you're issuing on the SEZ unit or developer, you may want to get yourself indemnified through the customer for reimbursing you the taxes which you may have to suffer if in case you're not able to prove that the said goods are for authorized operations of the SEZ unit or developer. So this particular change in a contractual terms may have to be brought in. So since we have good amount of time now, next 20-25 days, it's worthwhile to reinvent and go back to your agreements that you have with your customers who are in SEZ. See what are the contractual terms. See whether such kind of indemnities are there in the contract. Because if you don't have and if you fail to get to such indemnity in your contract, tomorrow the liability to pay the tax along with interest and penalty, if there is some, will be on you and not on the SEZ unit or developer from GST law perspective. Now, since this transaction that you're making to the SEZ unit or developer is held for not for the authorized operations, as I discussed earlier, would be treated as a regular supply. Once it is treated as a regular supply, it becomes a B2B supply. Once it is a B2B supply, the taxes which are required to be paid on the supply made to the SEZ unit or developer will have to be paid as an output tax to the government. Once you pay the output tax to the government, since it is not zero rated, you cannot claim back the refund of the tax paid by you as a supplier to the government. However, by virtue of this being not for authorized operations, the question of eligibility of the credit of the taxes that is charged by you to the SEZ unit or developer is a different discussion altogether, because we'll have to sit in the shoes of the SEZ unit or developer and demonstrate that the taxes which the vendor is charging, treating it not to be for authorized operation, whether it is for furthering the business or not, is a separate test which you have to test independently, so that you get the eligibility of the credits which have been charged by the supplier. I'm not discussing that because that's an altogether different discussion, maybe for a separate occasion. So to be read with conjunction, we spoke about this, so I'm skipping this. So I think this particular provision I would see as the most important provision which has been brought into the GST law. So very critical. One more point which I would like to make here, which I actually made as a post on LinkedIn today, is basically the amendment in the Finance Act was made and made into the IGST law in section 16(2), calling it to be for authorized operations to get the benefit of zero rated. However, the Finance Act said the provisions which have got amended has to be notified by the central government from a date from which the operation of this particular section will take place. Now, while notifying the date from which this particular provision will come into force, instead of issuing a notification under IGST, why? Because zero rated supply is defined under section 16 of the IGST Act. This particular notification deciding the date from which it is applicable has for some strange reason been issued under CGST Act. You can probably read my LinkedIn post, which I posted today morning, to understand a little more in detail about this. I'm not saying that by virtue of this notification being issued under CGST Act, the government has this notification has no force at all. I'm saying, is there a reason why this particular notification was issued under CGST Act, whereas the provisions are lying in IGST Act? This is a very good point which you can probably bring it on record in case tomorrow you get show cause notices on this matter saying that prove me for authorized operations, and you want to aggressively take it forward into litigation mode and say not required for authorized operation, any supply to SEZ is zero rated. Maybe this argument will come to your rescue. There's one more change when we speak about zero rated supply from a SEZ perspective of zero rated supply. Okay, so section 16(3) has been amended. Section 16(3) speaks about when you export goods or services without payment of tax and you claim refund of the accumulated input tax credit. Okay, this is claim of refund of accumulated input tax credit. We all know section 2(6) of the IGST Act says in case of export of services, one of the criteria is that the money has to be realized in convertible foreign exchange. Unlike services, for export of goods, no such condition has been prescribed. Export of goods means taking goods to outside India from India. That's the definition of export of goods under the IGST law. There is no condition attached to export of goods to say that money has to be realized in convertible foreign exchange. Now, in the intermittent, there was a rule which was inserted which said that if in case of export of goods on which you have gone and claimed the refund of the accumulated input tax credit and you fail to realize the sale proceeds within the time permitted under the FEMA, then the rule required you to pay back the refund which you had got from the government along with applicable interest. And it also further said, whenever in future you get back the money from your customer, that means you're able to realize the sale proceeds, you will be given back the refund, which was already given back to the government earlier. Now, this particular rule, which was inserted in 2022, had actually no legal backing. Why no legal backing? Is because the amended 16(3), which is on the screen right now, is exactly the same thing which I said is already there in the rule. The rule came in 2022. The particular provision enabling this rule in the GST Act by virtue of 16(3) proviso is getting affected only from 1st October 2023. What I was trying to make a point out of this is this rule 96B. Sorry, it was not 2022, it was 2020. I stand corrected to that effect. Rule 96B, which brought an embargo saying that if you're not able to realize the sale proceeds on export of goods, you are required to pay back the refund. Is how far the rule itself is correct in law, because the section is getting affected now. So the argument, or wherever there are notices issued by the government to recover the refund back, maybe you can definitely take an argument now to demonstrate that the proviso to rule 6 section 16(3), which talks about exactly the same thing which is there in rule 96B from February 2020, is a very good case that you can fight to say that the refund need not be paid back if the money was not realized, because that was not a precondition for export of goods. There is one more interesting discussion or amendment in section 16. So we spoke about 16(1). We spoke 16(1) is basically zero rated supply for our authorized operation. We spoke about 16(3), which said in case of export of goods, sale proceeds have to be realized within time limit. Now there is an amendment or insertion of 16(4), which talks about in case of a zero rated supply, if you want to make zero rated supply with payment of integrated tax. What does with payment of integrated tax means? That means you will supply you will export either to a party outside India or supply to a customer in SEZ unit. By not charging tax, you will choose the option to pay tax to the government and claim the refund of the taxes paid on the supply made to the respective customers. So that is zero rate supply with payment of tax. This was a free flow activity which was permitted hitherto. Now, with the amendment of this particular provision in 16(4), what the law says is in case of zero rate supply, where you want to choose the option to pay tax and then supply, you can only do for such category of transactions which will be notified through the by the central government. There are two categories which the provision says which has to be notified. First provision is the government will notify a class of goods or services which may be exported on payment of tax. The highlighted aspect here in this particular point is exported. That means this particular provision can only notify for an export transaction. That means what is a SEZ transaction cannot be notified through this particular provision. So any goods or services which will be notified under this particular provision, which is 16(4)(a), will only be for export transaction. Notification is already in place from 31st of July 2023, which says every export barring few products can be made with payment of tax. That means export of goods is permitted to be made out of India with payment of tax, and you can claim back the refund of the taxes paid. However, when it comes to export of supply to SEZ customers, which is the second aspect here, it says a class of person who may make zero rated supply with payment of tax. First category was they will define which class of goods and services can be exported with payment of tax. Second category is they'll define the person who can make zero rated supply with payment of tax. As we said in the first category, SEZ is not covered. The second category, both export as well as SEZ is covered, where we can make with payment of tax subject to notification being issued. Strangely till now, even though this provision will take effect now, strangely till now, a transaction to an SEZ, whether can be made with payment of tax or not, is not yet been notified. In the absence of a notification being issued under this particular class of transaction, at the moment, you cannot supply to an SEZ unit or developer with payment of tax. That means the only option available to you when it comes to supplies to an SEZ unit or a developer is you always have to supply without payment of tax and go on to the route of claiming the refund of the accumulated input tax credit. If you want to make SEZ supplies with payment of tax, you may have to make further till the time a notification has been issued under 16(4). I hope I'm clear here. Any doubts on any particular slide, you can actually refer to that particular discussion and put your questions. Maybe we can take it at the end. So all this discussion in slide 1 and 2 was predominantly around amendments in section 16 of the IGST Act, which was for zero rated supplies. Now we will try to jump into something which is again very interesting for all of us here. We know that we have been getting a lot of notices for the last 1.5 years on mismatch of ITC between 2B and 3B. This predominantly was coming as a notice in the form of A7010. There has been an amendment in the rules by way of insertion in the form of Rule 88D, where a procedure has been prescribed for the procedure to be followed by the department and the taxpayer whenever there is a discrepancy in ITC between these two set of data, that is GSTR 2B and GSTR 3B. So what does it say? Rule 88B says where ITC has been claimed in excess of GSTR 2B in the 3B, a trigger point would be a notice would be issued by the department in form DRC 01C. That means an intimation will be issued to you in 01C saying that you have claimed credit in excess of what is appearing in 2B. This generally will be for a tax period. There is a catch in this particular rule. The catch here is it says the rule has to define, or rather this rule, subsequent to this rule coming into effect, the council has to recommend the margin by which there has to be excess claim. That means if my 3B amount is 100 and my 2B amount is say 80, the difference of 2B between 3B is 20. If the recommendation by the council is say in excess of 20% of the 2B, then if I claim anything in excess of 20% of 2B, in my example, it's in excess of 20%, then an intimation can get triggered under DRC 01C. However, in the very example, if 2B was say 80 and the recommendation by the council is say 20% and I have claimed only 10% in excess of 2B, a notice or an intimation cannot get triggered under 01C. Strangely, till date, there is no recommendation by the council on the amount or the percentage by which the difference between 3B and 2B can get kicked in by virtue of DRC 01C. One more interesting aspect which I've colored in red here is hitherto wherever you see the recommendation of council appears in any of the provisions of the law, it says by notification through a recommendation of the council. That means it always said first the council would recommend, then the government will issue such recommendation through a notification. Strangely, in Rule 88D and 88C, which I'll discuss very briefly in the next slide, uses the term by such amount and by such percentage as may be recommended by the council. It doesn't talk about a notification to be issued under this particular rule by the government. This is very strange. I don't know how the council is going to recommend the amount and the percentage which is required for the purpose of 88D. It will be interesting to see. It will also be interesting to see the wires of such notification, whether it will be legally okay or not okay. But we'll have to wait and watch. As of date, even though this provision has come into effect, there is no recommendation by the council to decide on the percentage of the amount basis of which this kind of intimation can be sent to the taxpayers. So once you get this intimation, what is the remedy? You either have to accept and pay the differential ITC which is claimed in excess through DRC 03 or give satisfactory response to the officer within 7 days of serving this 01C. What will happen where the any amount remains unpaid? That means you do not agree and you do not respond, then it remains unpaid, or you give us explanation which is not acceptable to the officer, it will convert into a 73-74 notice. That means you'll get a show cause notice by virtue of a difference in Rule 88D between the ITC in 3B and 2B. Once you get a notice under 73 or 74, the normal litigation route would follow and thereby you can proceed further. Likewise, for difference between ITC in 3B and 2B, there was a rule inserted in 88C with effect from December 2022 for difference in output tax between 1 and 3B. The provisions are more or less similar. The only difference being under 88D for mismatch in ITC, the route finally goes into notice under 73-74. Under 88C, it will not get into 73-74. It will get into section 79. That means recovery of the amount of difference between GSTR 1 and 3B. That's the only difference between 88C and 88D. Then you have an amendment in Rule 142B, which speaks about recovery. So what 142B says is whenever there is a recovery required to be made under 88C, which is on top, which is for the difference of output tax between GSTR 1 and 3B, the same has to be first intimated through recovery notice wide 01 shall be wide 01D and then within 7 days, an action is required in the form of payment of tax to the government. Please beware, if you look at 01D, DRC 01D, there is no option to explain your case. No, it is only a recovery notice issued to give you 7 days time before they start proceedings to recover or attach your bank account. The only action which is permissible under 79 or rather 01D is to pay within 7 days. If you don't pay within 7 days, the recovery proceedings would be initiated. So there is no response which is possible in this particular transaction. The next amendment is amendment to Rule 108 and 109. Both these rules talk about how an appeal has to be filed in APL 01 or APL 03. APL 01 is an appeal filed by the taxpayer. APL 03 is an appeal filed by the department. They say the appeal has to always be filed electronically, because we always have this question whether I have to file the appeal online or whether I have to give a submission of my appeal along with the annexure offline. The answer is, in all cases, the appeals have to be filed online electronically. However, there are a couple of exceptions which have been given in the said rule. They've said wherever commissioner notifies that an appeal can be filed physically or manually, only in such cases the same can be filed manually. And the second category is if the order itself is served other than electronically, the appeal by default obviously cannot be served or rather filed on the portal. It might have to be given physically. So only these two are the circumstances where a physical submission of an appeal is possible both by the department as well as the taxpayer. In all other cases, if an order has been served on the portal, the only action by the taxpayer or the appellant for that matter has to be that the appeal has to be filed on the portal electronically. Finally, we had seen this amendment being made in the Finance Act. A date had to be notified from when this particular provision would retrospectively have implications under the GST law. So this specifically talks about two transactions in Schedule 3, which is covered through Para 7 and Para 8. Para 7 is out and out sale. We call this out and out sale because the goods are outside India and the customer is also outside India, but the contracting party is in India. That means you are sitting in India, you get an order from, say, customer in Singapore to buy something from, say, Dubai and deliver it to Singapore. Now, by virtue of this supply or a purchase order from a Singapore party, you might back to back give a purchase order to the party in Dubai to supply or ship goods directly from Dubai to Singapore. So this is typically what is covered in Para 7. There were a lot of discussions around this when the GST law came in to understand whether this particular transaction can fit into GST law to be made taxable because the person contracting the supply is sitting in India. Even though there were a lot of strong points to say that it is not taxable, there were few conservative, taxpayers who taken a view that we will pay up taxes so that, we don't have to face the litigation going forward. They have some respite now. This particular transaction is put into Schedule 3. Whatever is put into Schedule 3 would be called neither supply of goods nor supply of services. Thereby, this particular transaction is outside the GST net. Saving in disguise, blessing in disguise is also that this will not be treated as an exempt supply for our purposes of reversal of input tax credit. So no input tax credit reversal is also required on the common credits taken by the person sitting in India. The second item in the Schedule 3, which has been given retrospective effect from July 1 is two transactions rather in Para 8. One is supply of warehouse goods before the same is cleared for home consumption. That is, if there is a public bonded warehouse or a private bonded warehouse where the goods are situated or located and there is a transaction of a sale between parties and subsequently the buyer clears the goods, then the first sale between which happens when the goods were warehoused would be out of the GST net is what Para 8A talks about. That means any sale made while the goods are stored or stocked in a warehouse, which is public or private, would not be a supply for the purpose of GST law. The second transaction, which is again listed in the Schedule 3, is predominantly high sea sales. That means when the goods are shipped from a foreign territory, before it reaches the customs port in India, if there is a sale made by virtue of transfer of title in the goods through the transfer of title to the goods, then such transfer of title to the goods when the goods are in transit would not be taxable under the GST law because those are not supplies by virtue of it getting listed in Schedule 3. So for our understanding, I have worded this as high C sales because in industry terms, this is called as an high C sales. So thereby high C sales also forms part of Schedule 3, not taxable. Again, every high C sale, or rather every high C sale again is not an exempt supply for the purpose of GST law. So no credits are required to be reversed in the hands of the person sitting in India who makes this sale when the goods are in high seas. Now, since this amendment came much later, and as I told you, there were a lot of taxpayers who took a very conservative view to pay taxes on para 7 and para 8 items. The amendment also says so that if the taxes have already been paid by the taxpayer, the refund of the same will not be allowed in the hands of the taxpayers. So what is paid is paid. If something is not paid, he is the person who's been saved by virtue of this amendment. Continuing from what we discussed in the previous slide, we said that supply of goods when the same are warehoused in a public or private warehouse are not supplies for the purpose of GST. I also made a passing comment that the same are not also considered as an exempt supply for the purpose of reversal of input tax credit under Rule 42 and 43. However, there is a catch there. If you go to section 17.3, the explanation speaks about supply of warehouse goods to the extent it is prescribed would be called as an exempt supply for the purpose of reversal under Rule 42-43. It is very important for us to go back to that provision because generally if you prima facie read that provision, it appears that everything which is warehoused and sold when the goods are warehoused appears to be exempt. The catch is that not all warehouse goods are actually exempt. Only such warehouse goods which are prescribed for these purposes are actually to be considered as exempt supply for the purpose of Rule 42-43. There is an amendment, there is a notification notifying in an explanation which appears after Rule 43 in the rules, calling sales made when the goods are in duty free, when the duty free goods are supplied in the arrival terminal in the international airport as a category of warehouse goods, which would be treated as an exempt supply for the purpose of Rule 42-43. That means those warehouse goods which are sold as duty free goods in the arrival terminal in the international airport are the category of warehouse goods which are exempt, treated as exempt rather, for the purpose of computation of Rule 42 and 43. So all other warehouse goods when sold, when they are warehoused in a private or public bonded warehouse, are not to be treated as exempt supply for the purpose of Rule 42 and 43. Okay, I think I'm clear here. The next amendment in section 17.5, which talks about block credit, and this anyways is something I think most of us are trying to follow even without a provision being there in the law, is ITC on any purchase of goods or services for carrying out CSR activities, corporate social responsibility activities. Now there is an insertion of a particular subclause in section 17.5 which says any ITC on CSR, any ITC on goods and services procured in relation to activities carried out for CSR purposes has been listed as a block credit. You have to keep in mind, if you carefully read the particular amendment, it says that the such CSR activities which are obligations under section 135 of the Companies Act are the CSR activities which would be actually called as a block credit. Thereby, maybe if you're able to demonstrate that there is a voluntary CSR activity not being obligated under section 135 of the Companies Act, which you're carrying out as a social citizen, then probably such ITC which you incur on those CSR activities may still be eligible in the hands of the company if you still meet the requirement criteria under 16.1. That is for the purpose of business. Keep in mind, because I am given to understand, even though I don't practice income tax, any expenditure on CSR apparently is disallowed under section 37 of the Income Tax Act. Now, even if something is disallowed under section 37 and is still not obligatory under 135, will we be able to pass the test? Litmus test under section 16.1 will be a bigger question to answer. If you're able to pass the test and prove something is for business, not obligated under section 135, maybe you might get through and then claim input tax rate on such input tax credit incurred on CSR activities. I have 10 more minutes, so we'll see how many more points can I cover. This is again very interesting. I mean, I should thank Manasa for this. She helped me, draw this table, which actually helps us to understand how the rules and the sections actually move. Many a times, as I already told you in the first slide, rules come first and the provision comes next, which ideally should not be the case. Again, we have such similar case even in this particular provision in section 16.2. We know that if a particular vendor's payment on which I've claimed input tax credit is not made within 180 days, we are required to reverse the input tax credit claimed as such invoices from that vendor. This is a known provision under the GST law. This is in second provision to 16.2. However, this is very, very small subtle change. What I'm interested in is only the interest element, not the row number 1 and 2. Row number 1 and 2 I've broken it into period. Any transactions prior to 1st October 22, between 1st October 22 to 30th September 23 and 1st October 23 onwards. When we speak about prior to October 1, 2022, they said if there is non-payment of 180 days, on the 181st day, you add back the liability as an output tax and pay interest under section 50 bracket 1 is what 16.2 read with 37 said. That means the law said don't treat it as reversal input tax, treat it as an output tax payment, pay interest under 50 bracket 1. No problem. I think that is what we had tried to do all this while up to October 1, 2022. Come October 1, 2022 till 30th September 2023, which is 23 days away. The section 16.2 of the GST law says still add back to the output tax liability. Whereas October 1, 2022, there was an amendment in Rule 37, which says pay or reverse an amount equal to ITC along with interest under section 50. Now, the law says pay as an output tax. Section says pay as an output tax. Rule says pay or reverse an amount. So this amount which you have to pay or reverse, is it an output tax or will it be reversal of input tax? Since pay or reverse is the terminology used, I'll probably say if you have ITC balance, you're either reversing through ITC balance or reverse if there is shortfall in ITC balance, pay through cash. Thereby, I would read this amendment in the rule as a reversal of input tax than an addition of output tax. So section says addition of output tax, rule says reversal of input tax. Now the question comes, which section do I pay the interest under? Because section 50 bracket 1, the interest computation is as an output tax shortfall. Section 50 bracket 3 is an interest computed for wrong claim of input tax credit. Very interesting to know because both rates of tax are 18%. Interest is 18%. However, shortfall of rather output tax addition will call for interest from day one. Reversal of input tax will call for interest only from the time there is shortfall in the balance of input tax credit. That means you took a credit, you maintain the balance all through, and you reverse after 180th day. You ideally don't have to pay interest under section 50 bracket 3. You took a credit, you maintain the balance all through, you pay as an output tax on 181st day. You may have to pay interest from day one and not on the date of reversal. Thereby, there is a difference being something called as an output tax and something called as a reversal of input tax. Now, I have a put question because I myself don't know the answer because section says output tax, rule says input tax. If section, as we know, prevails over rule, then probably interest is under 50 bracket 1 for the intervening period between October 1, 2022 to September 30, 2023. Now, what happens from October 1, 2023? Both rule and the section are aligned. Section also says paid by him along with interest. Rule also says pay or reverse an amount equal to ITC. I would believe pay by him along with interest would have to be read as reversal of input tax and read along with the rule. Thereby, I feel the interest under 50 bracket 3 should kick in and not under 50 bracket 1. 50 bracket 3 is always beneficial to the taxpayer, as I explained for the second bucket here. So the discrepancy between section and the rule predominantly is for the in-between intervening period of October 1, 2022 to September 30, 2023. We don't know the section under which interest has to be paid. 50 bracket 3 is beneficial to the taxpayer. 50 bracket 1 is beneficial to the department, and we know what notices are going to come because what is beneficial to the department is the notice which will definitely get, especially if the section is talking about adding to the output tax liability. Yeah, this is my partner Hanish's very topic which he likes most. So, but I would like to dwell into this now. Recently, couple of days back, we got an advisory. I don't know how much of legal backing does an advisory have, because this is not coming through the act, not coming through the rules, not coming through notification, not coming through circular. It is a GST portal which says what has to be done on the portal. Okay, so now there is proposed to be a new statement which should be added on the GST portal, calling by name electronic credit and reclaim statement. Okay, what is this? We'll have to go a little behind and understand what was the requirement under the GST rules, and then come back to the statement. Last year, July 2022, there was a sea change in the way GSTR 3B was supposed to be filed. The way we used to file versus the way the portal, or rather the rules required us to file, was a lot of change. What was the change? Hitherto, rather up to July 2022, we always filed ITC. This all related to ITC. We always showed or disclosed ITC in table 4 of GSTR 3B from a books perspective. Come July 2022, we had to show, based on the amendment to the rules, from the GSTR 2B perspective. That means what? Table 4A5. It's a little technical now. Table 4A5 of GSTR 3B, which talks about all other ITC, the circular and the rule said that show the balance of GSTR 2B for that particular month in table 4A5. They said if out of 4A5, you know something is ineligible, show in 4B1. They called it as permanent reversal. They said if something you cannot claim today, but you can claim tomorrow on satisfying few things, maybe receipt of goods or receipt of invoice, or for that matter, few other things, they said show it in 4B2. 4B2, by virtue of the circular which was issued, we understood it to be temporary reversal. So they said something you are not sure today at the time of filing 3-year GSTR 3B for a month, claim in 4A5 based on 2B, reverse in 4B2, calling it as temporary, reserving the right to claim back in a subsequent month, showing again in 4A5, disclosing such reclaim in 4D1. Go back to your book and please rehearse, because it's not easy, because I myself took a lot of time to rehearse this particular thing. There is 4A5, there is 4B1, there is 4B2, there is 4D1. All these are like a multiplication thing in your mathematics. So you should know these respective tables. So whenever you reclaimed, there were two disclosures required. Go to 4A5, show in 4D1. Why is it required? To again show the difference between 4A5 minus 4D1 to match it to that particular month's GSTR 2B. So now this is very complex. Okay, so this we understood. So a lot of taxpayers, including clients, they said, how on earth do we even implement this? Because if something is not even accounted in the books, how can I go by GSTR 2B? Because if water is appearing in GSTR 2B, I don't even know what is it for. I don't even know whether that invoice pertains to me. I don't even know whether I'll account it this month, next month, after 1 year. I don't even know whether I will pay to the vendor, so there is a dispute on the invoice or not. That being the case, I may be able to follow the particular revised GSTR 3B, or I may not. A lot of guys actually took the route of not following it, even though some of them very religiously followed the requirement of the new GSTR 3B. So whoever followed, now the advisory says that wherever you have claimed and temporarily reversed without reclaiming it back till date, that is till date they have taken it as July 2023. Till July 2023, if you have claimed something in the past, temporarily reversed and not reclaimed it back because some conditions are not fulfilled, such items, they're calling it as opening balance of the credit statement, the statement which is on the slide. So that is called as an opening balance. So what does it mean? This statement, understand it to be an accounting ledger. So this will act like an accounting ledger now. Every accounting ledger we know will have an opening balance. If it's a balance sheet item, treat this like a balance sheet item. So this balance sheet item has an opening balance. That opening balance, obviously portal doesn't know how to compute. It is saying taxpayer, please compute and tell me how it is. It says whatever you have claimed in the past, reversed, not reclaimed, compute all that balance and put it in the opening balance. They said, we said, okay, we will do that. Okay, so for doing this, they're given us time till 30th November 2023. You have to be careful here. 30th November 2023 is the date up to which they have given you to report the opening balance as on July 2023, not up to November 2023. So whatever is the balance up to July 2023, which you feel should form part of opening balance of this particular statement or ledger, can be reported till 30th November. As we know, and we have multiple times we have knocked the doors of the High Court, we will definitely make mistakes and we want revision, and revision not once, not twice, three times. So now they have understood it upfront, and that I'll give you 3 times opportunity to correct if in case you have done any mistake while reporting the opening balance. However, all such mistakes which you want to do, but correct it before 31st of December 2023. That means till 30th November 2023, I've got time to report my opening balance as on June 2023 with the right to revise such balance up to 31st December 2023 3 times. So no more saying that portal never gave me time. Portal never gave me an opportunity to correct. They themselves have accepted you will make mistake. They themselves know that you will make mistake multiple times. 3 times is what they have understood to be the maximum mistakes possible. And thereby 31st December is the due date before which you have to make such corrections. So once you arrive at the opening balance, that is the balance which will be maintained on the portal. So from August return onwards, you actually have to do which you were required to do from 2022 onwards. The re-emphasizing the fact saying that boss, you have not done all this while. Please do it from now. I will keep a tab of what is your closing balance of the credits which are yet to be claimed, which are temporarily reversed. That means all this while we had to do in an Excel spreadsheet. From henceforth, the portal itself will keep a balance of the credit which is reversed temporarily, which can be reclaimed by you. So it says that there is a checkpoint. Obviously, once you maintain a ledger, the balance cannot go negative. So once you put opening balance and start adjusting such opening balance by reclaiming it, if you go beyond your opening balance, there'll be a red flag saying that boss, you don't even have such credit. How are you reclaiming? That means that will tell you, I will give you a notice if you do this, but still you might go ahead and do what is inevitable. That means you'll go ahead and claim if you rightfully feel that something you are required to claim may be not forming part of opening balance. So what the law says is, if you're going beyond the balance in the statement, it will give a red flag that will not stop you from filing the GST or 3B. You can overcome that and still go ahead and file the 3B by claiming balance beyond the statement balance. However, be sure that you will get a notice saying that without an opening balance or a balance in the statement, you have claimed or reclaimed the credit. I'm not going to discuss this. Maybe we'll share this slide with all of you. Period wise, you have split and said, if you have followed the particular new regime, what will happen? If you have not followed, what will happen? If you have reversed and not reclaimed, what will happen? If there is 2A balance which have shown reversed but not reclaimed, what will happen? So this slide actually depicts all sorts of situations. We will share it with you after the session is done. You can go take it at go through at leisure and ask us questions if you have some. 5 more minutes, I'll try to wind up. So yeah, the next point is this transportation of goods. The place of supply is a big debate. Intrastate supply in section 12.8 has a proviso that if the transportation of goods is to a place outside India, then the place of supply is the destination of the goods. Even though the contracting parties, that the supplier of the transportation of service goods, transportation of goods of service goods, and the recipient of such service both are in India, the law deemed the place of supply to be outside India. Thereby, we had a challenge. Nevertheless, there was an exemption up till September 2022 for transportation of goods from the customs port to a place outside India in a aircraft or a vessel. But from September 2022 onwards, we did not have any exemption available. Nevertheless, this proviso, which determined the place to be outside India, is proposed or rather omitted from the Act. Thereby, the place of supply is now based on the registered person's place. If it's a B2B, wherever the registered person who's contracting this supply is there, the place of supply is that particular place. If it's B2C, address on record is the place. Sorry, location where goods are handed over is the place. Likewise, we have a section in interstate supply, rather section 13.9, when the transaction is between one party in India, one party is outside India. There again, we had a particular section 13.9. The section itself is omitted. Since the section is omitted, which had similar provisions like 12, section is omitted, the place of supply will go into the residuary rule of location of the recipient base. That means if your recipient is in India, the place of supply is India. If the recipient is outside India, the place of supply will be outside India. This is a pretty simple provision, so not discussing much. I will skip this. This is very, very procedural. Maybe once we share this slide, it's very simple because this requires some time to discuss, but I think self-explanatory. See if I can discuss something which is important. I'll come back to this particular thing. This is important. So if you take any new registration, you are required to obviously update your bank account or furnish the bank account on the portal. Earlier, or rather till now, we had 45 days time to update our bank account on the portal in your registration. From October 1st, you have got time of earliest of the two events. One is before you file the first GSTR1 or from 30 days of granting the registration to you. In case if you're not able to furnish your bank account before this date, before this earliest of these two dates, you will be prevented from filing your GSTR1. So very important for new registrants to ensure that the bank account details are furnished at the earliest. To this. Yeah, revocation, rather suspension of registration, 88C and 88D, what we spoke about. If there is continuing non-compliance in 88C and 88D, that calls for a suspension of registration. Also, as we spoke on the first here in the slide, if you don't furnish the bank account within the time specified, that also calls for suspension of the registration. This is very, very procedural. Yeah. Now, earlier, your GSTR 1, 3B, 9, 8, all your returns which are required under the law, there was no deadline as such, to say that beyond this time you will not be able to file these set of returns. Now, a deadline or a dead end has been, date has been inserted. All these three returns cannot be filed after 3 years from the due date of furnishing of such returns which are prescribed under the law. That means if GSTR 1 statement is required to be filed on 11th of the subsequent one, you add 3 more years from that date. Beyond that, a GSTR 1 cannot be filed at all. Likewise for 3B, likewise for 9 and 8. Skip, I'll tell you. Okay, I'll go now since I have 2-3 minutes. I'll go to your e-com related matter. Yeah. Last 2 slides and I can conclude from here. So section 24, rather section 23(2) was amended to give power to the government to notify a class of person who, notwithstanding the compulsory registration under section 24 and notwithstanding the thresholds prescribed in section 22(1), can be given the status to not register under the GST law. Under this power, the government has through notification 34/23, notified supplier of goods who supplies through e-commerce operator as the class of persons who are not required to compulsory register, even though they are one set of people who are required to register under section 24. I'll rephrase this. If you are supplying goods through an e-com platform, all this while, because section 24 had compulsory registration requirement if you are supplying through e-commerce operator, now by virtue of this notification, even though you are supplying through e-commerce operator, you are not compulsory required to register. There are some requirements or criteria fixed which you have to meet to get into this exemption. They say that if your aggregate turnover for getting into the exemption, your aggregate turnover all India basis in the preceding and the current financial year should still be below the threshold of 20 lakhs or 40 lakhs as the case may be. You are not required, you are not supposed to make interstate supply. You are also not supposed to make supplies through e-com in more than one state. That means if you are registered in say Karnataka and Tamil Nadu, in Karnataka you are already supplying through e-com in the state of Karnataka, you cannot again do the similar kind of thing in Tamil Nadu as well. Third is you shall compulsorily have a PAN. Such PAN has to be declared on the GST portal along with your place of business. Once you declare the PAN, you have to get an enrollment number through the portal. Such enrollment number will have to be given to the e-com operator. So once you have such enrollment number is when the e-com operator will onboard you and he'll allow you to supply through the platform, that too only intrastate, not interstate outside that particular state. So these are the conditions. If you actually violate any of these conditions, you will immediately come out of the exemption and be required to compulsory register under the GST Act. Consequent to this, in the composition section under section 10, there has been amendment. All this while, if you were a composition, I would say dealer as a very loosely used term. If you are a composition dealer, you are not allowed to supply goods through an e-commerce platform. Now there is a relaxation to that only for supply of goods. Still supply of services is not allowed through the e-commerce platform. Supply of goods is allowed to be through made through an e-commerce operator if certain conditions are fulfilled. Likewise, what we spoke, you shall do only intrastate supplies. The operator will actually do TCS. Ideally, the TCS, which is under section 52, will be more or less equal to the tax which the composition dealer is required to pay under section 11. Thereby, once the e-commerce operator deducts TCS and remits to the government and reflects in his GST rate, which comes as a credit to me in cash ledger, that itself probably would be sufficient for me to pay the whole of the tax under composition under section 11 to the government, because the rate of tax is the same, 2% and 2%, as 1% and 1% as the case may be. So composition dealer henceforth is allowed to supply goods on the e-commerce platform subject to these conditions of making only intrastate supplies. We have mostly covered whatever I wanted to. The other ones are very, very trivial and small procedural aspects. I may not wish to cover now since we have already passed the time which we had allotted for this session. Yeah, now I'll get into Q&A if we have some questions. Are there anything? Tejal, you say, can it be 13.3A? Are you talking from the context of transportation of goods? You can say yes or no in the chat box. Okay, so I would not believe it will be 13.3A, because 13.3A covers the situation where services supplied in respect of goods which are required to be made physically available by the recipient in order to provide the services. So I believe, I mean, this is a different discussion, separate discussion altogether, but I would believe 13.3A, the supplier is required to work on the goods. Here in this case, the supplier is only enabling the movement of the goods. So thereby covering under 13.3A, in my view, even though a possibility cannot be discounted, is difficult to get into 13.3A is what I would believe. That probably is what I would believe. Mr. Manjunath says, can we claim ITC of CSR expenses? We said that section 17.5 FA has brought in an embargo to claim credit on ITC of CSR expenses met for an obligation under section 135 of the Companies Act. If not for that, we had a discussion on that very in detail. If not for that, if you say you're doing this voluntarily, and if you're able to meet the 16.1 test, to calling it to be for business purposes, I feel the credit should be made eligible. Siddharth, yes, we'll share the presentation. Any more questions? I don't see anything. Was the topic so easy, or was something which we didn't understand at all? Anything else? So Rahul says, if we reverse ITC under Rule 37 in the same month in which ITC is auto-populated in to be written, then interest liability is there. There should not be any interest because there should not be interest for the fact that you have claimed and reversed in the same month. You will have to only do this exercise of computation of interest if you have carried forward a claimed credit, carry forwarded it, or utilized it. Subsequently, you reverse it by virtue of Rule 37 is when interest should probably kick in. If you have claimed and reversed in the same month, there is no question about paying of interest. How much backwards one needs to go for opening balance? Maybe I'll go back to my PPT, and that is what I think Manas has tried to explain in that particular table. So I believe if there is a reversal made under Rule 37, you can go back to as much as July 17 as well from the time GST law came in, because there is no embargo or there is no restriction in reclaiming that back on a later date, because you already claimed and reversed, and the Rule 37 allows you to reclaim. When we come to Rule 37A, which talks about a situation where the supplier has uploaded in GSTR1 and reflecting in my 2B, whereas his 3B is not filed, only there is probably, since December 22 is when the provision came into picture, you cannot go back behind that. It can only be from December 2022 onwards. When it comes to GSTR 2B and then you disclosing in 3B accordingly as per the new GSTR 3B regime, it only came from August 2022 onwards. It can only be from that date. Okay, I know. I think what Tejal is trying to ask is, can I go back to an earlier year where it is not Rule 37? I have only claimed and reversed in my September 3B, reserving the right to reclaim. I would probably feel you can still do so if you have claimed and reversed. There is no explicit provision in the law to say that you can reclaim this back, because only explicit provision which says about reclaim is 37 and 37A. There is no provision for claiming as per 2B, reversing and reclaiming on a later date other than 37 and 37A, in the absence of which even otherwise I would feel that such balance also can be formed part of the opening balance. And that has been the practice all through, that every September right from 2018 onwards, we have been saying what are the items which are there, which are still not reflecting either in 2B or there in 2B have not accounted. I have claimed, reversed in September and tried to reclaim it back on a later date whenever it has got reflected in 2B or 2A, or whenever I've accounted the invoice in my books of accounts. Some values wrongly reversed under 38 rule 38, 42, and 43 of CGST rules and section 17.5 column. Can I adjust it? If you are able to demonstrate through your workings of that particular month what forms part of your reversal, which is temporary and permanent, and able to say that procedurally I've disclosed it under wrong head, I think you should be able to sail through. But you should have workings evidencing that you have declared it under wrong column. Instead of showing it in 4B2, you have by mistake showed it in 4B1. You should show it in opening balance, because you should reserve the right to reclaim. Because if you don't get into the opening balance, there is no question about fighting it in the future. Please be a little aggressive while showing in the opening balance, because crediting the opening balance is not crediting the ledger. There is no liability on account of you showing as opening balance. Only when you subsequently adjust it with your reclaim it or adjust it with your credits or output is when the liability of interest and the liability of recovering the tax would come into picture. Be little open to claim it in opening balance. Later again, maybe you want to do your due diligence to see whether that opening balance which you have shown, you want to reclaim it or not by virtue of showing under wrong head or by virtue of it belonging to 2017-18 for which the period is already gone and all of that. I would say opening balance, be aggressive. Crediting subsequently to the credit ledger, be a little cautious when you want to reclaim it back. Yes. We are following the process of availing the ITC on 100% matching basis with compared to 2B. Yeah, this is the practice which was followed, up to July 2022. Subsequently, from August 22 onwards, the requirement is not that you just match and reconcile in your Excel. The requirement is that show as per 2B and temporarily reverse in 4B2 and subsequently reclaim whenever you account it in the books of accounts or pass the test of eligibility of credits. So thereby, matching or reconciling in your Excel spreadsheet would not help. You have to disclose as required under this particular provision. I know it is voluminous. I know it becomes very difficult, but nevertheless, the requirement of the law is this. If you deviate, be ready for the non-compliance and the notices following such non-compliance. And there are taxpayers or registered persons who are actually following this, who have a lot of transactions, 20,000, 30,000, 40,000, or rather even more line items on a monthly basis, who have put a system in place where the disclosure as per the new table 4 of the GSTR 3B have been met. Okay, I think We got good 6-7 questions which we took. I don't see any more questions which are coming. So thank you so much for the patience listening. I was happy interacting with you guys. Even though interaction was only on the chat box, nevertheless, I got to get good value adds from you guys, and I also enjoyed the process of preparing this PPT, because if not for this PPT, probably I would have postponed reading all these provisions. And I would like to thank Manasa, my colleague, for helping me out in this PPT. She is the Karta Dharta of the PPT. Thank you so much. Thanks, guys. Please do join us for the next session whenever it is scheduled. Thank you.